Hello everyone, today is Friday, and on Fridays I kind of wanted to give a little bit more information about like retirement and the retirement kind of conundrum. There's tons of different parts. Again, Monday I just focus primarily on Medicare, and on Fridays I do a little bit more of a broad base retirement topic. Newsletter and video. Now, I don't know how many folks keep your eye close on the market like I do. Stock market had a huge rally yesterday and then pretty much went below that already today. It's only 12 p.m. Central Standard Time, so we still have 3 hours left in the trading day, but we've been dumping all day. But today, I wanted to talk about long-term care and something called the filial law. And the reason why I bring this up is because I got this email from a financial planner that I work with, and it kind of groups Medicare and long-term care together, which I understand is a misconcept for a lot of the people that I help. I do my best to illustrate that Medicare does not pay for long-term care. That's what Medicaid might pay for. Now, for those of you folks who are looking at or kind of now finally thinking about long-term care, there will be some solutions towards the end of the video, but I kind of wanted to go over a little bit about assets, income, and paying for long-term care. So in here, they give us Medicare supplement, what it is, Medicare Advantage, what it is, and then living benefits rider and hybrid policies. Now, many people may be thinking, well, this is odd. This has nothing to do with Medicare. And it doesn't. But it's grouped here in the Medicare will cover all health costs. And what basically this shows us is the different types of long-term care products. Now, this is not the extent of it. There are long-term care policies traditionally that are pay as you go type, where you're consistently paying premiums into the policy. That's the traditional long-term care, what a lot of people are familiar with, and that a lot of people cannot afford because it is really expensive. So what can we do about it? Well, first, let's go ahead and contextualize how much money people would need. Now, recently, unstable times, I talked a little about how the market has been going down all day. Inflation has been going up. The core interest rates, or the interest rates that the Federal Reserve, monitors and controls, that's going up. Retirees on Social Security have have $30 less per month due to the inflation cost of everything, even though they had a cost of living adjustment. So things are not looking so good for the consumer, and especially for those who are retired. This cool thing here about how $1 million doesn't go very far, and most of my clients who live in Hawaii will have seen that or are experiencing that $1 million doesn't really last that long. This wonderful ranking puts Hawaii at about number 1, where $1 million in savings will last you 10 years, 10 months, and 11 days. Pretty scary, right? And they break it down via the average costs here. As we move down the list, we get to the cheaper states, but Hawaii does rank really high, as does New York, California, Massachusetts, Oregon, Alaska, Maryland, Connecticut, Vermont, New Jersey, Maine, etc., etc. So then what can you do? Well, Washington has implemented a long-term care tax, and what the long-term care tax does is it taxes 58 cents per $100 of wages, and they are putting that money into a trust to pay for long-term care. Now, the long-term care benefit that they are promising is actually only $36,000 a year. Now, $36,000 a year, even in Washington, hang on, that's monthly. $36,000 a year will barely cover the cost of adult daycare today. And this fund is not going to be accessible until 2026. So, there we go. 2026, in 5 years, that's when people will be able to access the fund. And it starts from 2022, so that's 4 years. And at 4 years, because they use a vesting period of 10 years, you actually only get 40% of the benefit. It is indexed for inflation. I don't know how they're going to index it, but it is going to be indexed for inflation. As you can see, it's barely going to cover the cost of adult daycare. It's definitely not going to cover nursing homes, and it's definitely not going to cover the cost of in-home care. And on the site, they clearly mentioned that it's only going to cover, or it's only meant to cover, 20 hours per week of in-home care. From what I understand, most people who need long-term care help, long-term care services, don't only need 20 hours a week. For example, my grandfather, he requires not only that his son stay home with him all day, rotate with each one of his five children, my mom and her 4 siblings, but also requires my younger brother to be there every day from 12 midnight to 5 in the morning to make sure that he can wake up in the middle of the night, use the restroom, and that he has, if he's up at night and needs any help, my brother, who is rested throughout the day, is able to take care of him at night. So that's a lot of help. And my grandpa, who's in his early 90s, he's been this way for a good 3, 4, 5, 6 years already. So, even though it does help, I guess, the $36,000 a year, it's definitely not enough to fill the gap. In addition, I found this law here. It's called the filial responsibility law. And basically what it says is if you are not entitled to Medicaid, where Medicaid pays for long-term care services or any medical expenses, if you have a medical bill, it could be a nursing home, it could be just surgery, it could be a hospital, and the person who is responsible for that bill passes away, the state, the hospital, medical service provider, nursing home is able to actually go and try and find a child who is able to pay for this bill, Now, the reason why Medicaid itself, if you're qualified for it, does not allow the nursing home and the medical services community to go after said child is because Medicaid has what's called the MERP, which is the Medicaid Estate Recovery. And what that program does is it pretty much says, okay, this individual who's on Medicaid, they had a house. Now that this person is no longer with us, they no longer need that house, Medicaid can actually go after that house to recover some of the costs of the services that Medicaid paid out. It actually recovers all the services that Medicaid paid out. So it can be a very dicey place when you don't have said kind of plans in place. Now, one of the best things I found is that there's federal law that prevents the states from going after people or children who have parent bills that are outstanding. And as of right now, it's still pretty much precedent that the federal law will always trump the state law, which the state is the one who can go after. And it says, again, I'll try and link to as many of the stuff as I possibly can. But there are only 30 states, well, only it's more than half, states that allow this type of recovery on the state level. Unfortunately, none of them include California and Hawaii, I believe. Oh no, California is one of them. I'm sorry. But Hawaii is not on the list of states that allow or that have these filial responsibility law. And federal law, again, forbids the nursing facilities to require payment from children. So, as far as those nursing home long-term care law or costs come in, you're pretty much safe. So what am I trying to say, and where are we going with this? Well, as we know, Medicare is running out of money. Medicaid is a state that's their biggest, I guess, liability on their balance sheet, and there has already been think tanks and like new laws being at least cooked up to try and not only limit the amount of Medicaid eligibility, but also limit the amount of funds that go in. And as Washington has recently done, what they did now is they have set up a non-Medicaid way for people to incur long-term care costs without qualifying for Medicaid. So under the regular Medicaid law, at least as far as I understand it in Hawaii, when you are qualified for Medicaid medically, which is pretty much the exact same qualifications as the Washington State Long-Term Care Trust eligibility, then Medicaid puts a eligibility date stamp on it and says, well, if you blow through all of your assets, during this time, they have a calculator to figure out when you'd be able to qualify for Medicaid right there. And then when you qualify for Medicaid, because of the MERP, that Medicaid Estate Recovery Program, all the medical costs are burdened to the state and only the person who incurred those costs. Now, if they remove that provision and now have the Washington State Long-Term Care Fund pay for long-term care, and you kind of just support your parent that way, it unfortunately sucks a lot of the money from just the parent's assets, but also incorporates the revolving family's assets as well. And thus, we're not having this person qualify for Medicaid. Now, I know qualifying for Medicaid isn't ideal, but it is, and it does provide very, very strong security for everyone else's assets. By not having people go onto Medicaid, you lose those protections, and that's one of the main things that I look at when I'm looking at assets and insurance and what's what and where's the windfall. So it's something to really think about, to have money there, because it's going to be a huge cost. Now, like I said before, Medicaid, you don't have to worry if you qualified for it. One thing I also found out that was pretty alarming is that in a Medicaid qualified nursing home, or one that has a high population of Medicaid patients, the nurse to patient ratio is much smaller. So in a Medicaid qualified home, you could be looking at 1 nurse to 16 patients. Whereas in a private pay or a nursing facility that has, insurance companies pay, like if you had a long-term care plan pay, you're looking at 1 nurse to 4 patients. So that's like the nurses in the Medicaid home, they're looking at 400% more, 4 times as many more patients. So that can really affect the care that you or your parents will get, right? So that's another thing that really you have to think about when looking at the assets of what you're going to how assets are going to be spent if something were to happen. So I said I'd give you a couple of ideas, or a couple of things you can do, even if you're retired, even if you are aged. And before we do that, though, I have to kind of preface it by saying that there are 2 types of long-term care policies. Many people I've spoken to they're unsure of how long-term care policies work. So long-term care policies have a cash indemnity benefit and or a reimbursement benefit. Now the cash indemnity benefit, what that does, it requires you to be a really good record keeper in case of an audit, because what that policy does is it shoots you all the money that you're eligible for. So if you buy a policy that has a $10,000 per month payout, the insurance company will simply give you $10,000 and expect you to provide receipts to the IRS if you are ever audited. The reimbursement side doesn't give you the full $10,000, but what it does is it gives you all of the reimbursements that you require, and typically you're going to be getting a little bit more for your money on the reimbursement side because it is only reimbursing claims that are actually being paid for, as in the cash side you can almost be sure that people who are on this policy will be taking out as much as they possibly can per month and not basing it on just the claims or just the actual medical costs incurred. So with that said, the policy that I talk about is on this side, it's the reimbursement side, and that's just simply because it's easier, it's cheaper, it's more efficient. So One America, they offer two types of policies. They have an asset-based long-term care, but they're both asset-based long-term care pretty much, which allows you to go ahead and buy a second to die, or if it's just you, a life insurance policy and attach long-term care benefits onto it. Now the long-term care benefits that you attach onto it typically are going to be more than the life insurance. And I can't give you numbers because it does depend on your age, but you can have these things be one-time pay, you can have these things be 10 pay or continuous pay. And the one true benefit of this policy is this policy alone, I think there's maybe one other company in the world that offers a policy like this, but this policy can be purchased with no benefit limit. What that means is there's no limit on the length of time that you will be able to get benefits. So if you need care, there's a study that came out in 2019. The longest person on care is 19 years. It's a male, and for females it's 18 years. And the reason why is because many of these cognitive disorders affect the brain but don't affect the body. So the body can remain alive, but the cognitive state can decline. It can decline for a very long time and stay in that lower or needing help kind of situation for a very long time. And on top of the 19 years, about 13.5% of all these claims, or all these beneficiaries of the long-term care policy, actually had to stop collecting benefits because their benefit period ran out. So it's a lot of people who are going beyond the standard average length of time. So this policy does pay for the entire length of time. It's based off a life insurance policy. Now for those folks who may not be qualified for the life insurance portion of long-term care, there's also something called annuity care. And in the annuity care, what you do is you're buying an annuity, and the annuity has long-term care benefits. Now, what is the benefit of just not? Well, why would you just pull out the annuity without, restricting it to just having long-term care benefits? Well, the reason is because for long-term care, any gains that are in said annuity are tax-free when used for long-term care. So you could even take an older annuity. Let's say you have an annuity that you've had for, let's say, 20 years, and it has a whole ton of gains in it, and you just don't want to touch it because you know that annuities have huge tax implications. They're a non-qualified annuity. They're not in an IRA, not a 401k. If you move it into a annuity that is meant for long-term care, any long-term care benefits paid out from the annuity are tax-free. So it does give you a little bit of tax advantage in that way. Now this annuity care, unlike the asset care product, is actually a 60-month max, or it's 24 months and then an additional 36 months in most states. Some states you can pull it out a little bit longer, but it really does depend on your state. And I'm sorry for you folks in Hawaii, this product is not available in Hawaii, but it does allow you to, for those of you that can purchase it, kind of shift some of your assets into something that is going to be more advantageous, gives you maybe a 2-to-1 return on your investment right off the back, and tax-free on some of that for long-term care services. So that's something that I kind of want to talk about. But for those of you who maybe don't have assets and have higher income, you can always use something called short-term care. That's not going to satisfy the long-term care kind of cost, but it will give you a little bit of buffer so that you can make those more, financially costly decisions with a little bit more money when it comes to managing the long-term care risk. You would definitely will have the long tail risk of long-term care, like the lengthier versions or the lengthier risks, like having it for 19 years or 18 years or something. But at least you would be able to get rid of the normal distribution risk of long-term care, and that's needing care 7 out of 10 times, of your peers, and then needing care for at least 3 to 6 months, and that's kind of your normal distribution. I don't like protecting against normal distribution only because I believe tail risk is where the actual risk is, but when it comes to long-term care and knowing that everyone's going to need it but no one has it, it becomes very important to at least have something so that you are able to manage and really feel, I guess, a little bit of comfort in knowing that there's something there, you know what it's going to pay for, and you also know what it's not going to pay for. Because a lot of people don't understand that there's a lot that medical insurance is not made to cover when it comes to long-term care. Medical insurance is not made to cover long-term care, period. Not even Medicare's Part A benefit. For those of you who are my clients, you've seen my videos, hopefully, about how the skilled nursing home care for Medicare Part A is very limited and is very strict. Most times it's not going to cover you, and it's almost definitely not going to cover you for the full 100-day benefit period that Medicare Part A says that you have. I hope you learned a little bit today about retirement, about long-term care. Be sure to subscribe, like this video if you liked it, leave a comment if you have any comments about what you want to see or learn about when it comes to retirement. I'll see you folks on Monday, where Monday we're going to go a little bit about Medicare Part D and how the prices and the plans are fluctuating their prices all over the place, and a little bit about what you can do to at least give yourself some form of sanity on the program. I'll see you there, and have a great weekend. Bye-bye now.